We're always told the economy is this fragile, perfectly balanced system, like a Swiss watch. Every gear matters. Every tiny adjustment can trigger second and third order effects that spiral out of control. And history backs that up. A small change in banking regulations once led to the worst economic collapse since the Great Depression. A minor currency adjustment on a random day wiped trillions of dollars off global markets. The lesson was always the same: mess with the system too much and it breaks. But here's the problem. Over just the past year, we've done the exact opposite of careful adjustments. We announced sweeping tariffs, then canceled them, then announced them again, then implemented them, then rolled them back, then raised them, and then lowered them, then created special exemption for certain companies and countries, only to cancel those deals and drag the whole thing into court where we might end up paying all of it back anyway. And now we're threatening tariffs again, including on countries that don't want to sell us Greenland. At the same time, we threatened our largest trading partners, threatened individual companies, threatened the chair of the Federal Reserve, shook up consumer finance, restarted debt repayments millions of people had been pretending didn't exist, all while firing tens of thousands of government workers, rehiring most of them, firing some again, and then shutting down the department that was doing the firing in the first place. We piled on new debt at a record pace, pushed through one of the biggest tax changes in decades, went through the longest government shutdown in U.S. history, and dramatically altered immigration flows in the labor market. And that's not even getting into the behind-the-scenes banking chaos, like the Basel III endgame, where banks still don't fully know how much capital they're actually supposed to hold. This isn't meant to be a partisan argument. Some of these issues, like student loans, genuinely needed to be addressed. But no matter where you land politically, one thing should be obvious. This is not how you treat a delicate system. If the economy really runs like a Swiss watch, then we haven't been adjusting it with precision tools. We've been hitting it with a jackhammer. And yet, it's still running. Economic growth didn't collapse. Unemployment stayed relatively low. Incomes went up, and the stock market, which is supposed to hate uncertainty, is hovering near all-time highs. Yes, these numbers hide real problems. Yes, the averages gloss over pain on the ground, but that actually makes the question even more uncomfortable. Plenty of economies in far better shape have folded under far less pressure. So with this level of turbulence, this many shocks, and this much instability, why hasn't the economy collapsed by now? That's the question. The obvious answer, the one you're probably already thinking, is the same one we've been circling around for the past year. AI. Massive AI investment has made the top line numbers look healthy. Trillions of dollars poured into data centers, chips, and infrastructure have essentially painted over the cracks. Under the surface, things are still decaying, but from far enough away, everything looks fine. In fact, according to the Bureau of Labor Statistics, GDP was growing at an annualized rate of over 4% in the third quarter of 2025. And unless something dramatic happened in Q4, the year looks strong on paper. But here's where it gets weird. That growth is now being driven more by AI infrastructure spending than by consumers, in the largest consumer economy on Earth. Even stranger, total investment in the economy actually declined slightly during that same period. So how can investment be the thing keeping the economy alive while also barely contributing to growth at all? Because it's a net number. AI spending alone added roughly 2.5% to growth, but that was almost perfectly offset by companies quietly selling off inventory they stockpiled before all the tariff chaos began. Businesses are emptying warehouses, not expanding production, which means if AI spending slows down even a little, the picture changes very fast. But that's still not the whole story, because government spending and trade somehow also look strong. And that leads to an even more dangerous question. Are the tariffs actually working? Spoiler alert, no. But to understand why these good numbers might be hiding something far worse, we need to talk about how money actually moves through the system, and that's where things get uncomfortable. This video is supported by Monarch Money. It's a private, ad-free personal finance platform that pulls all your accounts into one clean dashboard: spending, investments, loans, and net worth, without spreadsheets or mental gymnastics. What I like about Monarch is that it doesn't just tell you where your money went. Yes, it shows you the full picture, highlights what changed, and explains it in plain English. No constant alerts, no noise. Everything is read only, encrypted at bank-level security, and trusted by thousands of users with near-perfect ratings. I use it for monthly check-ins, and having everything in one place genuinely saves time and stress. If you want to try it, the link is in the description. Use code HMW50 for 50% off your first year. All right, back to the economy. Yes, imports into the US are down right now, but not because Americans suddenly decided to buy local. They're down because tariffs disrupted business spending and companies stocked up months ago, and now they're just burning through inventory. In many cases, there is no American alternative to switch to. So this isn't a success story. It's a waiting game. Exports, on the other hand, are up, which sounds impressive, until you look at what we're exporting. The fastest growing export category by a mile: precious metals. From late 2024 to late 2025, inflation-adjusted exports increased by about $26 billion. More than half of that, $14 billion, came from gold alone. That's a 500% plus increase year over year. Part of that was higher prices. But the bigger reason is more uncomfortable. Countries are trying to diversify away from the US dollar. Gold isn't being exported because America is dominating manufacturing. It's being exported because the world is looking for safer places to park wealth. Even after adjusting for price changes, we're still shipping massive amounts of gold to financial safe havens like Switzerland and London. Silver tells the same story, just louder. Silver exports grew by nearly 2,800%, adding another $4 billion. So out of a $26 billion export increase, roughly $18 billion came from selling gold and silver. The rest mostly came from military equipment and energy. That's why the trade balance looks good, not because the economy is thriving, but because businesses are scared to restock and we're selling off hard assets. It's like saying your household finances improved because you stopped grocery shopping, emptied your pantry, sold your car, and maybe a kidney. Cash flow looks great, but you can't do that forever. Calling this a going out of business sale might sound dramatic, but other countries rushing to pull fungible stores of value out of the US isn't exactly bullish. And then there's consumer spending. Normally, strong consumer spending is a good sign. People don't spend more unless they're earning more, or at least feel secure enough to stretch their budgets, and technically, consumer spending is still the largest contributor to GDP growth. But there's a catch. A record share of that spending is coming from the wealthiest households. This isn't broad-based confidence, it's asset-driven spending from people whose stocks, real estate, and private investments have exploded in value. But here's the key point. Even wealthy households usually pull back when they sense real danger. When bonuses shrink, when businesses falter, when markets feel unstable, and that's not happening. To see if anything, the opposite is true. High-income households are spending too aggressively, to the point that we're now seeing a record number of very wealthy Americans running into financial trouble. Which raises a deeply uncomfortable question. If the people with the most information, the most assets, and the most buffers aren't acting cautiously, what exactly are they betting on? And more importantly, what happens when that confidence finally breaks? Individually, a lot of these decisions might look reckless, but collectively, they've created a strange kind of stability. Businesses are still producing, services are still expanding. even if more and more of that production is aimed almost exclusively at the wealthiest consumers. So maybe all the collapse talk was overblown, right? Well, let's look at one very good number and why it's actually a bad one. A huge share of recent consumer spending growth came from healthcare and other non durable goods. And according to the data, that category is overwhelmingly driven by pharmaceuticals. Yes, insurance premiums are up. Yes, prescription prices are higher. But these statistics are designed to adjust for price increases and focus on actual output. So, why is healthcare output rising so fast? There are three main reasons. First, we simply need more healthcare. Americans are getting older, heavier, sicker, and less engaged with preventative health. That alone creates massive, unavoidable demand. Second, the explosion of new pharmaceutical treatments, especially GLP-1 style drugs, has driven an entirely new wave of spending. And third, fear. A lot of people believe their health coverage may change or disappear in the near future, so they're rushing to use it while they still can. It's a classic use it before you lose it scenario. Layered on top of all this is a deeply bureaucratic system with broken incentives, something I'll be breaking down in a dedicated video soon, so make sure you're subscribed for that. In the short term, all of this boosts consumer spending, because healthcare is expensive, and when you need it, it's not optional. So yes, this helps explain why the economy looks red hot on paper. Growth is real, there's no denying that. But a lot of that growth is coming from spending that is either non-discretionary or unsustainable. And that's before we even touch the biggest caveat of all, currency. The economy may have grown by around 4%. But over the same period, the US dollar has fallen by more than 10% against most major currencies. That doesn't mean we're secretly 6% worse off, but it does mean some numbers look better than they should while quietly signaling problems ahead. Take the stock market. In dollar terms, it's at record highs, which helps explain why wealthy households are still spending confidently, but measured in many other currencies. Markets have traded flat or even slightly down. A weaker dollar also makes exports cheaper and imports more expensive. That helps explain why trade numbers suddenly look healthier. If your portfolio went up 10%, you might feel rich enough to spend more. But when imported goods or overseas travel also cost 10% more, local options suddenly seem reasonable. If we were a net exporting economy, that might actually help. But we aren't. We're the largest net importer on Earth. So in practice, this mostly just makes everyday life more expensive. And that's before tariffs. A major study tracking over 25 million transactions found that foreign exporters absorbed about 4% of tariff costs, while 96% was passed directly to consumers. So yes, we're importing less. And paying more for it, not great. Still, not a collapse. And that's the uncomfortable truth. It's simply too early. The American economy isn't invincible, but it is enormous, deeply connected, and extremely privileged. Its size alone slows everything down. Capital doesn't flee overnight. Supply chains don't reroute instantly. Trust erodes gradually. The US is also embedded in an almost absurd number of alliances, agreements, partnerships, and informal understandings across the global economy. They've been stressed, they've been tested, but no matter how hard we try, they don't fall apart all at once. In the short term, that's good. It gives us time to see problems forming. But it also means that if the world starts slowly working around the US instead of with it, recovery will take far longer than anyone expects. And it doesn't help that many of the biggest decisions shaping this future are being made by people who won't be around to live with the consequences. If you want to understand how that power dynamic is starting to shift, watch the next video on screen. Thanks for watching. If you found this useful, hit the like button. It really helps the channel. Subscribe for more videos breaking down how money, markets, and power actually work. See you in the next one.